All right, guys, thanks so much for coming. My name is Molly. Kicking off 2024. Appreciate you guys coming tonight. And this is the first time we've hosted in this facility, so we're kind of working out the kinks and all that type of stuff, like locked doors and all that fun stuff. But so I am one of the founding members of Wise Denver. Wise is a group that is nationwide. It actually started in Texas with Dee Boring, and she just kind of was investing in multifamily and just realized that women weren't really represented in the investment fields. And so she's like, hey, I just want to do a meetup. And so she started with a meetup in Dallas, and then now we're across the country and growing like wildfire. There's 5 chapters in Texas alone. Denver, Seattle, Raleigh, I think there's a stat on here, we have like 3 more opening up. We have Scott Hendricks with Homestead Title. He is not only our fabulous host, but why else would you want to be a guy on a women's board? So we've got Scott and we've got Kari, and Kari is helping out videoing and you name it, doing social media and all that fun stuff. So Wise started as Women in Multifamily, and multifamily is kind of a scary word, so we changed it. So it became Wise, which is Wise Women Invest in Real Estate. And basically we're covering all commercial asset classes. So land, self-storage, syndication, you name it. We're working on, educating anyone on all the different asset classes. January announcements. All right, we got 3 new chapters starting this month. We have a new website coming. It's sheiswise.com. I think that's supposed to be kicking off this week. So that will be where you can see where all the other chapters are and anything along those lines. There is Wise Her, which is launching in March. That is actually a subscription-based model that's going to have a much more in-depth classes and networking and that type of stuff. That's going to be part of the national organization. But again, these meetings are always going to be free. We're always going to have free speakers. It's not, we're not going to be charging you to come here. Wise Heart, gratitude is powerful. So we're trying to figure out ways to give back in all the markets. So we'll be figuring out where we're going to be donating some of our time, money, effort, all that stuff. Wise Mind, watch for ways you can improve your mind, body, and spirit this year, which I think we're all working on, right? And regional events will start in the fall. So that's that. Sponsorships, we are always looking for sponsors. So let's say Homestead has been amazing as far as providing alcohol and locations.
just the alcohol and location part.
A good snack across the head when I need it, whatever. So, but if you're interested, or if you know of a company that would be interested in sponsoring a women's group, definitely.
So you can reach out to Dee, or if locally, if there's something we can do, reach out to myself or Molly, Kari.
Yep. We are not financial advisors. Do not take my advice. Figure it out on your own. No, I'm just kidding. We're all about education, but I can't guarantee anything. We're focused on commercial real estate. Many networking groups out there that focus on real estate. Wise focuses on multifamily, self-storage, industrial, and other assets. The ways to buy property through syndication. Drink responsibly. You know about that. Ways to invest in multifamily. You can buy it yourself. Buy it and manage it.
That's not me. It's got a mind of its own. It hates me.
Okay, yeah, I'll do quick. You can joint venture or partner with someone. You can form a syndication. You can invest passively in syndications. So there is a bunch of different ways that you can invest in commercial real estate assets. Just so you know. A real estate syndication is a partnership between a group of investors pooling their resources into a single investment. Most people, don't know how to own an apartment building. That's how you own an apartment building. You basically, it's a team sport. You get a bunch of people together, you get their money together, you get their knowledge or, professional aspects together, and you do it, you take down the apartment as a group. Syndication players. So there's general partners. Those are the ones that actually find the deal, are the bones of the deal. They go in and do negotiating and all that type of stuff. There is the lender, who is going to be the biggest investor usually. Limited partners, those are passive investors. They don't have as much say in the deal. They kind of, here's my money and give me my returns, type of thing. And then there's real estate professionals, of course, because we need real estate professionals, says the realtor.
I second that.
Syndications, as a limited partner, you have cash flow, you have a profit from the sale, and your risk level is medium. You're putting money in, you're getting money back. As a general partner, there's several more ways to get paid. However, there's a lot more work involved. So you can get acquisition fee, which is payment for finding the deal, putting in the risk, capital, earnest money deposits, payment for all of the back-end transactions like title, bank, appraisers, etc. There's the cash flow from the rental, there's the profit from the sale. Risk level, there is a substantial risk on being a general partner on deals. However, there's also a substantial return. So, all right, welcome our speakers.
Guys, thank you so much for coming and hanging out with everybody here at Wise. So tonight, my job as a title rep is obviously to get to the finish line, have a closer come and make sure that you get your syndication or that goes across the finish line. One of the hardest obstacles in 2023, I was a former banker and lender for 15 years, and so access to capital was extremely difficult in 2023. So we decided we'd kick off the year with 3 different individuals. So we've got Adam Aluise. Adam is, I usually say a broker lender partner, in terms of that, where goes and looks at what your deal looks like, and then it has several resources throughout the country in terms of helping to place and find that deal through different arms. So just a really good resource to be able to do that, and he's going to explain that further. We've got Tanner with great Tailwind. So he's in the life insurance areas, there's Lifeco areas, and then we also have Brian Zener and Abram. I'm going to go with Abram because if I try their last name, I'm going to be it wrong. And they are with Solera National Bank, and they are going to speak towards what their program looks like from a self-directed IRA. So we've got 3 different avenues, going to kind of look through, let these guys kind of take the floor from there, and show you different ways other than your traditional lenders to get capital. So thank you guys for coming, and thank you guys.
Thanks, Scott. I appreciate why having us here at Slatt Capital, so I can explain a little bit about who Slatt Capital is and what we do. So we are commercial mortgage bankers, right? And so we will help place the debt or the loans. We have 30 correspondent life insurance companies, right? So that means that life insurance companies have a bucket of capital that they will deploy and invest in commercial real estate, and they task us with finding the deals, right? The multifamily deals, the industrial deals, the self-storage deals. We work with national, super regional, and local lenders here in town, whether it be like banks or credit unions. We have alternative financing, which is going to be more of kind of hard money or bank REITs that will do kind of bridge loan. We place equity as well. So if you were putting a project together and a little bit larger than family and friends, we could help find a partner that would go in for your equity piece of the deal. And then we also do agency. So I don't know if anybody here is familiar with the agencies on the commercial real estate side, or I guess it's most specifically to multifamily. So Fannie and Freddie have their own little bucket of capital that they'll help. I'm trying to think of the best way to be helpful to the group here, so try to make it a little bit more interactive, just so we can share like information that is going to be valuable to you guys, rather than just like using buzzwords and trying to like look smart. But so how many people in here have actually, well, first off, I thought this was a multifamily thing specifically. We can go into all asset classes, but just like specifically multifamily, do people understand like what the actual definition is? It's just 5+ units. You know what I mean? So it's not 1 to 4. That's a different bucket. So it's 5 to 500 units, right? And who here is actually invested in something like that? So, and you guys own them now?
Mm-hmm.
The portion of right, or like as a limited partner, right? Right. A
Yes.
general partner come in here and they're like, hey, Nate, can you invest a little bit, and you get a quarterly or semi-annual distribution or something like that. So it's good, first off, so people have a good understanding. And so, on the debt placement side, what we've been hearing or asked about most of all is, how much debt can I get? right? Because 2 or 3 years ago, you could finance up to 75 or 80%, and it was like no questions asked. Pricing or interest rates were at 3%. You know, I mean, it was just kind of the Wild West. Now it's kind of changed a little bit where because pricing has gone up a little bit, your leverage or loan to cost, loan to value is going to go less. So you're going to have to bring in more equity, either personally by yourself or raise it somewhere separately with your network, as you syndicate your deals. What is sizing your deal now is the debt service coverage ratio. I mean, is everybody kind of familiar with what a debt service coverage ratio is and how to calculate it? It's super easy, right? I mean, your net operating income, rents, you take out all your expenses, and that gets you to your net operating income divided by the annual principal and interest payments. And so just a good rule of thumb is, you're gonna want a 1.25 debt service coverage ratio. That is what's going to size your deal, right? So you're like, oh, can I get 70, can I get 60, can I get 50, can I get 40? And it's gonna be different, dependent on probably location, right? I mean, a lot of different factors, I should say. And then pricing, number one. And so, on our side, we work with, and it looks like from people here, they're more value add, kind of, we're all in wealth creation mode rather than being like kind of some, older folks where it's wealth preservation, kind of throw into a bond or a triple net deal, and it just, kind of gives you your annuity. Usually what you're trying to find is value add deals, right? It seems in Denver, and I don't know how much you guys have been trying to identify, but it's been picked over 3 or 4 times, like the value's been added 3 or 4 times, right? And so, it's like, okay, where are we gonna go secondary or tertiary markets? Like, are you comfortable going to Colorado Springs? You can go to like Greeley, you go to Firestone, or Fort Collins, and so, or even outside of the state. So there's a lot of different things that come into play when you're getting your financing or identifying your property, but you should always, number one, size the deal to a 125 debt service coverage ratio, and that's going to size, how much debt you can actually get. So we do value add financing where it's like, hey, we bought it, this person hasn't been managing the property very well, so we're gonna go in there and do like what they call is like a lift, right? So you'll go in there and you got some old linoleum and tear that up and get some appliance package in there and kind of get rents where market is, and that's kind of the value creation piece of that. But for that, you need probably 12 to 24 months interest only, depending on the size of the deal. And then once you hit that stabilization piece, then you can get that longer term agency debt, or you can go with a credit union or a lender that maybe has a limited or reduced prepayment penalty in case you want to flip out. So we've been doing a lot of that here locally, and then nationally as well. There's also life insurance companies that do money, and they're going to be your best pricing. Spreads are probably, and I don't know the group's knowledge of just kind of how things are priced in the first place, right? I mean, a lot of people, just for the sake of conversation, they'll tie it to your US Treasury, right? Like the 3, 5, 7, 10-year terms with a spread over that. And life insurance companies are usually, depending on the asset, probably 135 basis points to 200. So, I mean, I think that the 10-year today was 4, like close to 4. So you're getting pricing in the high 5s, low 6s. Now, if you go to like banks, their spreads are a little wider, right? And so depending on who you're talking to and who has an appetite for commercial real estate, their pricing could be from 6.5 to, I talked to some people today and they were like 8. I was like, whoa, you are way out of the market right now. But there's just a lot of price uncertainty going on, trying to figure it out.
So those life insurance companies that your company's affiliated with, they're not investing, they're actually offering loans.
Yeah, so so I mean, there's the Standard is a life insurance company, right? And they work directly with us, and so, part of their investment annually is they'll say, we're going to deploy $2 billion in investment through commercial real estate.
And is the average for a no interest loan like 12 to 24 months right now? There's nothing longer than that?
It's gonna be just size based, right? Because, I mean, if and we're not speaking about development, just if you're going in there. Correct. If you're going in there right now and you're like, okay, look, do you have to wait for the tenants that are in there to roll off? Are you gonna go in there and give them cash so they beat it, and so you can immediately start your strategy? And so you might have to wait for people to roll off, but then it's gonna be, you know, if you want to turn one property at a time, right? It's like, what's your package? Give me a
No,
plans
I know.
package, but 12 to 24 months is what you're asking specifically. Can you get longer?
Right, exactly.
Yes.
Yeah, okay,
You can get full term IO,
okay, gotcha.
so.
So I guess why would everybody go with you, like, why would they go with a traditional bank then? If your rates are that much better?
So,
Like, under limits,
I
or
mean,
are they
but
more
because
expensive?
everything's relationship based, right? Because a lot of people just don't know what they don't know. I mean, there's a, Solera does a great job. I mean, I know BMO does a great job. There's different folks. I was in banking for 15 years, right? And it's just part of the credit cycle, right? I mean, people are gonna be open and closed more often throughout the year. And that's not because people don't know, right? I mean, some people just don't know they have better options, or different options. I shouldn't say better, different options, right? So, but that's, that, I guess in a little nutshell, we place capital, through banks, life insurance companies, agencies, REITs, and equity. Does that make sense at all? I mean, I don't know if even that even touched on anything or was helpful to anybody in the whole, like.
No, super helpful.
So if you do bring in like a REIT, you know, if you are short on capital or whatever, do they typically wanna be a preferred partner with a higher?
Yeah, they're gonna be for larger deals.
return?
So, if you're talking about bringing in equity, so it costs. And they're gonna wanna have some control in the deal. So I mean,
Okay.
that's kind of the trade-off, depending on the size.
Right,
Some people have like a minimum check of 5 million,
okay,
right? I've done, some investing. I would recommend, I mean, when you're starting up and getting things going, that you kind of pass the hat around. I mean, that's what I did at least. It's like, you know, mom, dad, friend, brother, like, hey, can you 50, 100, whatever it's gonna be, and do it, syndicate it that way.
right.
And as you grow, those opportunities will be provided to you.
Okay.
So-
Is 5 million kind of the minimum of the
No,
companies you work with?
no, I mean, what I found is like, there's, and I didn't, there's so much money out there, really. I mean, and honestly and truly, like, if you wanna get a deal done, you can, if you like grind for it. You can get $1 million check.
Okay.
I mean, but it's gotta be worth their while.
Right.
Right, and it's gonna be the same thing for everybody here, is what kind of return do you want for your investment? Like, what, is it like, you know, are you a cash on cash person? Are you like an IRR person? Like, it doesn't, everybody kinda has their own way of valuing, what's most important for them, right?
Okay.
So, but I will tell you, once you start taking money, it's like, it's expensive.
Right.
You know, they're professionals.
Like 2% over the normal rate, or what's?
No, I mean,
expensive?
as far as equity is concerned,
Yeah.
depending on like the dollar amount, they probably, like, are you familiar with like pref equity and?
No.
It'd be kind of 2 points, for their money in the first place. And then you'd have to give them a preferred return of between probably 7 and 10% before any other equity was paid back at all. And there's various waterfalls. I mean, we can do another, I don't wanna hog, I mean, everybody's here, to share their platform. I'm happy that I'm here, and I appreciate you giving me a little time.
What's your last name?
It's Aluise. I brought some little, little
great.
pass out things. I forgot to do it. Just like some folders. And then multifamily deals we did in the past like a couple years. It's not dated in 23, but I have to share. I feel like a teacher.
You kind of are a teacher right now.
You good? What's that?
It says you kind of are a teacher right now.
Oh,
so,
yeah.
you know.
Yeah.
I built this one.
Yeah.
Oh, I built that.
Yeah, that'd be great.
Thanks.
Excellent, thank you.
They may come back to you with questions, by the way. All right, so, Tanner, create Tailwind, got a hard act to follow now. Just kidding.
Real quick, raise your hands, who's heard of infinite banking? We got one. Okay, so, infinite banking, bank on yourself, there's a lot of names for it and whatnot. What we do is high cash value life insurance. And we show people how to warehouse their wealth there instead of anywhere else. Because what happens when you spend money out of a life insurance policy, anywhere else that you guys warehouse money, does your money continue to grow after you spend it out of there? No? But it's probably giving you like a 5%, no fee, no interest, rate of return, right? No, okay, it's not tax free. So what we do is we show people how to use high cash value life insurance to buy into these deals. A lot of times our clients are getting their down payments, they'll build their down payment in this, and then they'll recapture the money back into the policy as the returns come back. The beauty of this is it's a simple interest only loan. So you have 100 grand out, it's 5 grand a year, $1 million, that's 50 grand, whatever it is. It's simple interest loan. You're paying it back to yourself, even though your money's still growing at about 0.5%, maybe 1% more while it's out. So everything that you buy, you're gonna finance. Either you're paying somebody else interest, and we show you how to recapture that interest. You're paying them 7% interest, pay yourself back 7% interest, there's a 14% swing. Or we've got a lot of clients that'll do stuff with, you know, multifamily that they're not paying back a loan for, you know, the first 3 to 5 years. Well, that's not gonna hit creditors, that's not going anywhere. You're basically controlling the banking function in your life. What we look at is the volume of interest. So just so I know the math off the top of my head, $300,000 mortgage, 30 years at 5%, you'll pay $579,000. So 48 cents of every dollar is going to somebody else's benefit. Why wouldn't we want to recapture this? If I've got the money and I can make the payments, it doesn't change my cash flow of $1, and I recapture what I would pay somebody else. And so instead of looking at the market to make us money, you know, obviously real estate, I mean, like Adam was saying, 75% of the life insurance portfolios are going to real estate. Why wouldn't I just mimic what they're doing, right? If they're really good at making money. So back in the Great Depression, the life insurance companies got us out of the Great Depression. A lot of people really like the FDIC, but it's a $70 billion company insured $7.2 trillion of deposits. If it goes upside down, we're screwed. The life insurance companies that issue a policy, they have to have 7% more than the death benefit. A lot of our companies are double digits that we work with, but they're going out and buying real estate. They've got a little bit in bonds and stocks, and then they've got the products that they sell, and that gives them a return as well. And so what you're doing is you're, you know, with people that are buying much bigger real estate than we're doing. I mean, like when you're talking $2 billion, I mean, I would say that they're probably even doing a lot more than that in a year. I can't get into that, right? I mean, I want to get into a $2 billion deal, but you know, we're showing people how to control that banking function, how to recapture as much to yourself. Now, there's other assets out there that control your money more than you do. You know, when you've got a 401k or some of these other things, you can't have a really good return on a deal. I go, you know, I'm gonna go on vacation. I'm gonna go buy a car. I'm gonna go do, you know, I'm gonna get a new kitchen. No, you have full control in the banking, infinite banking, or the high cash valuable life, whatever you wanna call it, that you don't have in a lot of these places. So where you warehouse your money, we show people how to use it to recapture money, how to leverage their money, how to pay their taxes. You know, basically this is where all of your money should flow through. And, you know, I've got a handful of books, the Becoming Your Own Banker by Nelson Nash. And, you know, it talks about some of the recapturing stuff, things like that. But a lot of it is, we've seen a lot of people do a lot of different things. I mean, just in real estate, how many different avenues are there? How many different strategies? Buy and hold and flip is very different, right? You know, you may flip a multifamily building over 3 to 5 years. That's different than somebody wanting to buy 2 single family to get into multifamily. So we look at a lot of different strategies in there, whether it's your taxes, whether it's how you buy your cars, all these different things, and how much more wealth you can build yourself with the volatility basically being you and how you allocate your money. So that's kind of the 1,000-foot view, but most people don't know about it. It's funny because every Fortune 500 company does this. Bank of America's got like $25 billion of cash value in their policies. Obviously, they're using the life insurance companies, everything like that. So what we do is basically save money. I'm not saying, hey, I've got a higher rate of return than anything else you can find. No, A lot of you guys are good at finding high rates of return. What we show you is how to do a little bit better just by where you allocate your money. Is that easy enough for just throwing a fire hose at you guys? No questions?
Questions, I'm just,
Usually people have questions. I've been doing this for about 12 years, so any question you have.
So if I got a deal and I'm picking a random number, $5 million, is that conceivable, doing an insurance policy?
You have to have the cash in there. A lot of times,
Structure that for me.
so you would get your cash value up to $5 million. And honestly, if you were gonna have $5 million, if you got $5 million in cash, I'd go buy $25 million of real estate. Right? And I would still loan it out, and I still get better returns. I've got way more,
The idea would be to leverage it for multifamily investment,
yes.
in my case.
And so when you're spending that money out, let's say that you're making a 10% return. By using this cash, that gives you another 1%. Plus, you don't have anybody come down your back. I mean, if you're gonna rehab a property, you don't have anybody coming in and saying, hey, we need these payments coming in. You can have it for 20 years. You're the banker. You make 100% of these things. So if you go out and buy a car and you go, well, hey, it's Christmas, I'm not gonna make that payment. You're the repo guy too. So if you don't wanna let yourself use that car, or you just accept that, hey, I'm not using this car for a little while, you finally have control of your money for all these deals. If you build up $5 million, wanna go buy a $5 million property, and you know what your exit strategy is to put that back in your policy, do it. I mean, I've got a client right now that their strategy is they're paying their taxes for the next 15 years. They've got about what they think their business is gonna be worth at that point. And basically when they sell that business, they're gonna put it back in their policy. So you could be 15 years out, simple interest only loan. So on $1 million, it costs you 50 grand a year.
So you're just paying the monthly premiums on the policy then? Or how does-
The interest, that 50 grand is just out of the policy. You basically can't access that money,
Okay.
so it stays in the policy, so the policy doesn't lapse. But the monthly premiums or annual premiums you pay in, the first year is the hardest year. You put in, let's say $1 million, if we're building up to $5 million. You're gonna have 600 grand available. It doesn't matter if it's a $10,000 policy, $10 million policy, 60% that first year. Second year, you have 95% of what you put in. The third year, you put in $1, you get more than $1. Then we drop off the paid up additions rider that gives us that early cash value. Why most life insurance agents don't bring this is because that 60% that we're putting in takes away, if you put in 600 grand and I give it back to you, how much do you think I get paid?
Nothing, probably.
Not much, right? The 40% is where life insurance agents get paid, right? And so, but what happens is the paid up additions, I put in $1, I have $1 available. It's gonna be like that always. That's how your checking account is, right? I put in $1, I have $1. What happens on that fourth year is I put in $1, now I get more than $1. So I may get like $1.10 for the $1 I put in for that year. By year 10, I put in $1, I get $1.50 for what I put in. By year 20, I get $2 back for the $1 I put in. So where you warehouse your wealth, has anybody ever showed you that, here, we're gonna hedge inflation and we're gonna help your purchasing power by doing that? No. So there's a lot that I can give you guys, but if you think about it as where you warehouse your wealth, that's gonna help a little bit. And then going through just different deals. You may just like $5 million deals, you're the only partner in there and things like that. Okay, here's how we'll finance it. We'll build it up every 5-7 years, whatever it is to get there. We'll go buy that property and then we'll start over again.
I don't think I'll live that long, so.
Well, we hope. We've got an exit strategy for that.
We've already thought of that one.
So, but honestly, if you think that you're older and whatnot, anybody that you have insurable interest, whether it's your kids, business partners, things like that, you can put the policies on them. I've got a business right now that they're doing their key employees, and you can segregate it. So you can say, hey, these employees we're gonna offer this to, and these employees we're not. 401k, you
Can't do that.
So you can't discriminate and have those kind of things and go, okay, these people, I've got this guy who makes good money, he's 30, his rates, you know, the way it looks is better. You can get 10 times their income, in death benefit on an individual that is just, part of your family, something like that, they can get 20 times your income in death benefit. And so we've got, I mean, probably the highest I've got is a client with 30 policies. And he just takes all that cash value, goes and does what he's always been doing. He's got a trucking company, so there's a lot of trucks that they go finance, and he knows every 5-7 years that they're gonna need new trucks.
Yeah.
So he just finances it himself instead of paying the bank.
Yeah.
And so I can walk through illustrations on that, all those kind of things. I only brought
That's fine.
5 or 7 books, but if anybody's interested, we can definitely talk, right? So,
Thank you.
you're welcome.
So how does it work though, and I don't, like, this is all new to me, but when you say you put in $1 and you get $1.50 or whatever you said, like, how?
Because they're investing in the same thing. So a mutual company on a whole life contract, their returns, you're part owner of the company. And so the returns come back to you in dividends.
Got it.
And so I've been doing this for 12, 13 years now, and we've got clients that's just the policy. By you going out and putting it into different deals, recapturing your cars, all those different kind of things, and you pay yourself back, every about 10 years you can double what the numbers on the contract. So you've got the process and you have the policy. The process greatly outweighs the policy, but for all of the advantages we have of where you warehouse the wealth, that's why we put it into the life insurance company and then pull it out and do all these deals.
And that's a whole life policy?
Yep. There's universal life out there,
Yeah.
there's variable universal life. The fees on it are really expensive.
Yeah.
And then just to give you an example, there's a 5% loan rate, plus you have a 1% to 2% fee on a universal life policy. So it's like 6%, they'll give you anywhere from 2 to 7%. There's a lot of times that it's more 2 or under those, where we've got a 5% return, which is kind of between the two. It's a 4% loan rate, so now until you die. So like when we're talking about last year and how high the interest rates got, how hard it was to sell houses, things like that, this is contractually obligated that they have that money for it. You make 1%, it's basically a negative interest rate now until you die.
So all those people that got in 21 were loving it this past year because their interest rates were so high versus.
Yeah, well, it's basically taking all the noise out of it. You don't have to worry about what the market's doing. Market's up, down, doesn't hit your policy. The interest rates are contractually obligated that you're making money on what you spend. So yeah, I've got a negative interest rate now until I die. Plus, when I do die, we do have a strategy for that. Death benefit does go back. So.
And his whole life, I've heard that it's more beneficial for older folks than younger folks. Is that matter or not? Like,
You'd probably say the opposite. Oh, this is better for younger people. And I've heard all of it.
okay.
The way that we're designing the policies, putting that paid up additions on there, it's good for everybody. I mean, the older you are, the more cash you can put in. The younger you are, it's just using that money to overcome everything. I mean, we've got more debt now because of schooling and, basically the banks figured out, you go to school, you have $100,000 in debt, now you have to come to us for your house, for your car, for all these things. If we can get them out of that, or we can at least recapture as much as we can, I'd rather do that early than late. I'm not waiting for them to go, oh, okay, now you're able to do this, now you're able to do that.
But it's all based on how much money I have put into this.
Correct. Yeah.
What are the possible drawbacks, disadvantages of going your route? I mean, question to Adam a minute ago was, well, why wouldn't everybody just choose you? And then you have this other thing that I'm gonna be the banker and I don't have to worry about the other side. There's gotta be a pitfall somewhere along the way there.
So that first year, I actually had a meeting last week with the CPA that's very respected around here, 3-hour meeting. By the time we got done with it, he goes, well, you're losing money that first year. And it's IRS code 7702 that you cannot be ahead of what you've put in by year 7 and still be tax free. And so basically that's how they work it. 100% of what you put in by year 7 is gonna be in there, but that first year is tough.
Okay.
That's probably the biggest thing. And honestly, I would not, I mean, Grant sounds a lot savvier that he may just do a $5 million deal on his own, but especially when we're younger,
Right.
I wanna get up to whatever I have to use for a down payment and then have all this stuff. If I've got one property and nobody's in that property, I'm at 100% loss. If I've got 5 properties, nobody's in that one, now I'm still probably making money. If I run my loans and I look at how much I have to be able to still be profitable, I want it to be about 75%, maybe 70%. So I wouldn't be buying as much as that then, but if you've got the means to be able to do it and you don't want partners because partners can suck, you know, then okay.
That's
do
why
it
they're
that way.
partners.
Huh?
That's why they're partners.
Right. So it all depends on your strategy. We could start, you know, with you doing some of these syndications, doing the 80-20, and you may go, okay, well, hey, the bank still wants a loan, or, you know, after a certain period or whatever. You may say, okay, now I'm getting away from that. But other than that, I mean, this is over 200 years old. Most people don't know about it. Every Fortune 500 company is doing it. The life insurance companies got us out of the Great Depression. They've got more money than anything out there. If anything else happens, it is gonna be better. So, you know, the biggest thing is that first year hit. And we can show you backdating if your birthday is within the next 6 months. A lot of people will come to me and say, oh, I've got, you know, X amount of dollars. Okay, we'll take a quarter of that or half that, put it in this time. 6 months later, we'll pay another premium. Now, instead of that 60% hit on 100 grand, $1 million, now it's only on this smaller amount. So it helps people be able to get in while they're young and things like that. So I know, I mean, I've had astute doctors, lawyers, all these things that they go, you threw a lot at me, a lot of it sounds really good. You know, I've never had somebody go, oh, no, that all makes sense. So the first year
Oh,
it is.
totally got it.
Yeah,
Totally got
the
it.
first year is a lot of training, and then after that, I basically want people to be able to, you know, if they wanted to go sell this, they'd know all the ins and outs.
Excellent. All right, any other questions, real quick, before we jump off to, our next, group of speakers for Tanner?
You wanna go there, just go?
Rerun? No, you guys just stay right there, we'll put, because they got the slides, so
Yeah,
one of them's gonna go this way, one of them's gonna go this way, we'll make it work, so. Do you guys wanna talk from there, or spin the chairs, or spin around this way?
Yeah, I'll be brief. I don't even won't even stand up here if that's all right. My name is Ryan Zener. I work with Solera National Bank, and so I've been in the financial industry for about 20 years. And Solera National Bank's a local community bank. We have a national charter, so we can lend in all 50 states. And so we do a lot of creative stuff to help our investor clients. But the main part that we're here to talk about here today is we offer a self-directed IRA and 401k that very few banks offer. And Abram's in our self-directed department, and he agreed to come with me this evening. So thanks, Abram.
All right.
Well, yeah, I guess I'll stand up a little bit.
Abram's gonna stand up.
Yeah, my name is Abram. Yeah, last name is tough, but it's Chabanian. I work for Slatt Bank. Been doing it for about 10 years in banking, but I've been in self-service for about 7 years. So started at Solera about 2017. And the coolest thing is I'm assuming somebody has a 401k or IRA, I'm assuming? Anybody have an IRA? 401k? Okay. There's also what's called an employee-sponsored 401k where your employer offers the 401k. I'm assuming most people have it here. So this is kind of the same industry, but just a little bit more freedom is what I like to call it. So we'll talk about IRAs and 401ks. Most 401ks and IRAs, the way it works, they invest stocks, bonds, mutual funds, right? Usually there's limitations, right? Depending on who your servicer is. And that's all you can do. You kind of park your money and it grows, fluctuates, and you're kind of controlled by the market. You really don't have a say, right? So about 30 years ago, if I'm not mistaken or so, there was a big lawsuit where an owner of a company is like, well, I'm an owner and I don't have a 401k. I can't contribute to my retirement, and how do I do it? So then everyone going to court, won the court, and they passed the law that a self-employed individual can now own the solo 401k and contribute as an employer and an employee. So for example, I work for Solera National Bank, where employer contributes, right? And then I can contribute my portion. When you're a solo 401k, you have to be what we like to call as a self-employed or have no W-2 employees. And we created a huge presentation, so we're probably gonna be sliding through, so if you want to, you can probably reach out to Scott and he'll kind of provide it. Some of the things you can invest to, for example, with your 401k, you can't buy cryptocurrency, you can't buy real estate, you can't do no payables. I mean, there was a whole list.
Can't,
right on the right.
sorry.
Can't.
Can't.
Yeah, you can. I mean, you can't. Right now, I should say, make it easier. What happens is with a solo 401k or an IRA, you're allowed to invest all those things. On the right, I have a list, and there's actually a lot more. If we go to the next slide, it's easier to actually talk about what you cannot invest into. So you can't invest into pretty much right there. There's a couple. Can't invest in looks. Yeah, can't invest in antiques. Can't do gems. Yeah. Unfortunately, you can't be doing that stuff for your retirement. But we go to the next slide.
Gotcha.
Give it a sec here. Okay, so I'm going to talk brief about two different structures that you'll mostly see. So outside of the, like I said, employee sponsor plan or an IRA that's like a TD Ameritrade, Wells Fargo, Charles Schwab, you still don't really have a say. You can only invest into the pool of mutual funds or retirement investments they offer, in period. You can't pick and choose. Like Vanguard has its own index, TD Ameritrade, Charles Schwab has its own index. That's kind of the basics of it, right? Well, people actually don't know this, but every single person can own a self-directed IRA. And there's really two ways to structure it. The IRA can be structured as an IRA LLC, or you can have a custodian who allows you to invest into passive alternative investments without kind of playing that custodian role, wouldn't be your fiduciary responsibility. What they don't do, they can't advise you. So you still kind of pick your own investments and things like that, but you kind of take your own risk as well. But they have the fiduciary responsibility to kind of help you with that. The next setup is a solo 401k, which is a really big one for self-employed individuals. How many of you guys are self-employed? So if you have no W-2 employees, as it says right there, non-owner W-2 employees, and you're self-employed, you will qualify for a solo 401k. And the cool thing about a solo 401k is that you can put a lot more in contributions, because you can put a portion as an employer, because you own the company, and as an employee of that company. And there's a whole different structure there. We're not getting into it, but just so you kind of know that you can do that. And on top of that, there's also what's called catch-up contributions. So if you're in a certain age, you can increase that capital to do alternative investments. And again, all those things you can invest in real estate, securities, bonds, stocks, everything. I mean, cryptocurrency, gold, metal, commodities, there's so many other investments out there, no payables, you can do a lot of stuff. So I'll talk about just briefly, again, I'm touching like top stuff, so we go to the next slide.
Are the contribution limits the same for a solo 401k as they are for a regular 401k?
Yes, they are, but when you own a company,
Right,
you put on both sides.
Yeah.
Yep.
But as far as the amount that goes in
Yeah.
per year is the
Yeah,
same?
it's if I'm not mistaken, it's supposed to be increased this year. It's around 19,000 for employee and employer.
Okay.
Opposed to like an IRA, I think it's around 7,000 if I'm not mistaken. So essentially, solo 401k is a qualified retirement plan. So you can have a Roth or traditional, right? So pre-tax, after tax. It is majority of the plans that Solera Bank does. We help set up the structure as well. So essentially, we have in-house providers who've been doing it for 20 years, and we have a slide of that as well. But we essentially will ask you a lot of questions to see which category or product you fit in, to then tell you here's what you can do with it. So like at the solo 401k, you have to be self-employed, really important. You cannot do self-dealing. So, there's prohibited transactions, as I mentioned. So you can't, for example, partner up with your spouse and use your house, buy, like, say, an investment property and then live in it, right? You can't do that. That's self-dealing, because you're getting direct benefits. It's called prohibited transaction. Well, for example, say you're a solo 401k and your wife's solo 401k want to partner up and buy a real estate asset, you can do that. So there's so many different strategies, but it's usually invested in a space when you just don't want to deal with dealing with the stocks, bonds, mutual FAs, right? If you don't, not that the FAs are about to do their job wrong, but if you just don't want people to tell you what to do with your money, and you wanna take full control, you have that option in this space. The next slide. IRAs, as mentioned a little bit, IRAs, LLCs, the next slide. IRAs there's two ways to do it. IRA LLCs are what most people do it, and the reason why is because that's what gives you the checkbook privilege. There's a difference between me going to an auction. Let's go, you go to a real estate auction, you buy fix and flip, you do fix and holds, right? Well, usually on auctions, real estate, you have to provide a check right away on the spot. They're not gonna talk to you if you don't have the check in your hand. Well, if you have a custodian IRA, which also gives you the ability to do alternative investments, like for example, there's a company called Equity Trust, Preferred Trust, Provident Trust, they're custodians. You have to tell them and fill out a whole loan form, and then they will cut the check for you on your behalf. Well, the problem is most people don't want to deal with that. So what they do is they do what's called a self-directed IRA with checkbook control, where you are becoming the custodian and the plan administrator of your own plan. So what that means, the IRS code falls on your responsibility now, right? That's kind of what happens. So if you're willing to do that and take initiative of your own product, of your own investment, and grow your own investment, then you take full control. Next slide. I mean, like I said, Solera banks, you know, as Ryan mentioned it, we do both structures. And we, what the bank does, we just give you the ability, because we understand the space and it's such a niche, that we understand that people have to invest. So we're not gonna give you pushback or give you a hard time about it because we know what you're doing. You're essentially growing to alternative investments. So most banks don't wanna get into this space. Why? Because they don't understand it. We do, and we provide the service in-house and to help alternative investment clients to grow their portfolios, retirement portfolios. Next slide will be. It's there, man. So
I'm trying to be ahead of you.
yeah. So one of our providers, it's all good, it's all good. One of our providers was Justin Wyndham. He actually has 20 year plus experience. We have a slide on that, and again, Scott can maybe send that out if you guys want the whole PowerPoint. But essentially, you can set up an appointment with him, even if you just want to learn, right? Just to understand the product. Sit down with him, ask him some questions, and he'll tell you kind of where you fit. You know, we have a whole team design, we have it's a whole 9 yards, I guess you can say it that way. The next slide, it's one of the products that actually I started at Solera National Bank. Is now once you do and take that risk, and you know there is a risk, right? Because you're not taking your own control of your own retirement. Well, now you have the risk and the reward, correct? So you're either gonna grow your money, or you can lose it all. I gotta tell you, because that's how it is, right? It's the reality of retirement, right, and investment. So just leading with that, we want you to grow your retirement. So there's also what's called a risk. You do a lot of risk analysis, and a lot of people love real estate. Why? Because over time, real estate grows. So Solera Bank saw a opportunity. We created a product where we actually can help you grab your retirement account, so all your cash, let's say you have $100,000, and we can help you leverage it up to 70% to go buy real estate. And it's 100% owned by your retirement account. There's total, if I'm not mistaken, 6 lenders in the United States that do this. I'm just one of them. So that tells you how niche of a product this is. Just a little bit, some facts. We finance over $75 million. We lend in all 50 states. There's no junk fees, which happens a lot when you have niche type of products. We have over 20,000 customers that do IRAs and 401ks. Our depository limit in our product is designed for true commercial purposes, because we understand the investments you're gonna do, you need that type of banking service, so we have that. The next slide, I'll probably go next couple of slides, let's see where we're at. I mean, I'll talk about that, just keep going.
Gotcha.
Difference between big bank, when you go to Wells Fargo, go to a banker and say, hey, can I open up a solo 401k? He's gonna look at you, let me dial customer service and see if I get the right department, right? You're not gonna get that, right? Why is that important? Because as an investor, you have limited time, right? Because most of us have busy schedules, busy lives. So you want to deal with people that know what they're doing, and understanding that whatever you do, it's for your own benefit and to grow your retirement. So we created a product where pretty much, you can keep going. Yeah, keep going. I want to present like a deal. I don't know how much time I got, but okay. The reason why Ryan and I talked about it, why we want to present a deal, just to kind of truly show you guys like what we do on the lending side. So when you have an IRA and 401k, like I mentioned, you can leverage that to buy real estate. So obviously, one of the IRS code, it has to be non-recourse, so you can't personally guarantee the note. So that's one of the laws of the IRS. So we know that, and we created a product to kind of avoid this. So for this is an actual deal that we've done. Obviously, you'll see the rates are low. I think it's a 20, 21 or 22. I don't remember exactly, but this is exactly the deal. Adam saved me a lot of breath talking about debt to service coverage ratio. So thank you, man. So that's exactly what we use. So if you go on the next slide over, we pretty much plug in the numbers and it gives us DSCR on the bottom. Essentially, that DSCR has to be 125. That's what we use. So we don't require anything else. I'm not gonna check your IRS form, your IRS paperwork. I don't need your bank statements for cash liquidity. I don't need your W-2s or your 1099s. I don't care about that. All I care about is if your property can cash flow, then and you bind it to your retirement account and you have enough money in your IRA or 401k, then we'll finance the deal. Obviously, as he mentioned, the rates, because it's a niche product and not a lot of lenders do what we do, and so there's risk as well, of course, right? A real estate deal can go bad, customer can walk away from it, and all we can take is the property, right? So, and a bank perspective, obviously, we're gonna get paid. I always say straight up how it is. Banks will always get paid, okay? So it's not news probably, but so it will be higher fees, it'll be higher rates, but it also gives you that leverage vehicle to still grow your passive income without growing your portfolio, which you're building the equity in the house, but as well you have the cash flow. So we use just that. That's as simple as that is. We have another deal. A lot of stuff that most lenders do is long-term, short-term rentals. A lot of people don't like short-term rentals because it's a little bit dangerous. We actually offer that product in-house. So this is a cabin we did in Fort Tennessee. We use AirDNA. Have anybody heard about AirDNA? Yeah. So AirDNA, Rabu, VRBO. It's just pretty much gives a lot of that information on cash flow and what the property can kind of provide on income. And then we use those numbers and do what's called a stress test and to see the property cash flows. Again, there's a lot more involved, but I just thought it'd be nice to have that visual just so you guys can see what the bank thinks. You know, sometimes bankers and lenders, Adam knows, we crunch numbers all day. So for us, we try to present it as easy as possible, but whenever I do these type of events, I always like to give the back end so you can understand why we're asking a lot of these questions. And that's why there's a beautiful spreadsheet that does everything, but there's a lot of questions we have to ask you to make sure that the deal makes sense for the bank or for a lender, and the deal makes sense for you. And that's, we have a saying, you know, everybody has to eat, right? So might as well share the meal. So the next one, common reasons. I like how Scott said there's always a caveat, right? There's always something. So common reasons of decline, just straight up how it is, right? Because we still look at your credit, we don't determine anything with your credit, but we do determine if you're worthy of credit worthiness, right? That's important. So we do check your credit to make sure you don't have any bankruptcy, taxings, tax collections and things like that and so forth. Other common reasons why we do declines is if the DSCR is too low. There's things that's called exceptions. So if it's below the 125, but if you're dealing like 1-to-1, we won't touch that because it's just too big of a risk. If one wrong, cost throughout the year of expense, you just took away your whole cash flow, right? So just kind of thinking about those as an investor, like, okay, why is that DSCR number important for the lender? Well, that's important because whatever's left, that 25 or 25% net operating, that's truly your profits. So if you had an unexpected expense or something happened or your tenant is just went crazy and damaged your walls, well, you got to fix that because you got to get the next tenant in there. Well, that's all cost to you, right? So we already think that on your behalf, which is why that 125 number exists, because it helps you cover your expenses and things like that. Just kind of go into the more deeper than what Adam said, but investment has to be a habitable condition, so it has to be good condition. We do allow like cosmetic uplifts, so if you came in carpet, wall paint and things like that, but most of the time we have investors that there's a big industry for fix and flips and fix and holds. Unfortunately, most banks won't get involved in that just because it's very high risk. Because you get some people that get too excited. Oh man, I'm a real estate investor, and read one article, and took a risk, got the deal, and lost everything, and then there's a big problem, right? And I've seen so many stories where people made it and people not made it, but we always say encourage, if you're doing that route, There's also cool things like where you can get what's called a note payable. So if, let's say, you know, your friend or somebody can give you a note payable through their IRA or 401k, you can use that money to invest as well. So there's different strategies, there's different things you can do. Obviously, the rest of the stuff, yeah, I'm not trying to go like 100 miles an hour, you know. So much information, sorry. The next slide over. To also add, I know it's multifamily, I know we're talking about 1 to 4, which is residential. So all of our loans are structured as commercial loans that are designed to buy residential properties. But also, so we don't do the escrow and all that stuff, so you really get that true understanding of commercial lending. But also we do multifamily 5+ as well. So if you are multifamily, then we could do it. Syndications are a little bit tougher. We wouldn't do a syndication. I have a couple of contacts that can help you pull syndication if you want to do a deal like through your IRA 401k. There's actually a local company here, but
We could be a party to a syndication through, we could or we couldn't?
we could.
Okay.
Syndication is one of the investments you could do. Yeah. Yeah, so,
You can do a syndication, but you don't lend.
we don't lend on it, unfortunately, because there's too many investors, right? So
On the whole deal.
yeah, that's more would be like private lending,
Yeah.
things like that. But we actually have many customers who open up the account with Solera Bank because we provide the banking service, right, for that type of investment, and many of them go to syndication. So you guys might have heard a company, New Direction. They're locally here in Denver, maybe not, but they do a lot of syndications through like an IRA, or you say, for example, somebody came up and said, hey, let's pull some funds to buy an apartment complex. A lot of those borrowers are their IRAs and 401k, so it's a very known practice.
Teachers unions and things like that.
Yeah,
Sort of do
yeah,
that too.
yeah.
So I'm
And
sorry.
then, yes,
You switch, we were talking IRAs and 401ks, and then you switched to what Solera does as a banker.
Non-recourse loans.
yeah, so, yeah.
So now when you're
Go back.
talking about the syndication piece, you can invest in syndication through your solo 401k.
Yeah, so you actually do both.
Right, okay.
Yeah, so, yeah, sorry, we
Sorry,
kind of went like 100 miles an hour, so it's a great question.
Okay.
So, to pause there so a solo 401k and an IRA LLC, those are structures you use to
Right,
do alternative investments.
right.
One of the products you can invest to build your real estate portfolio is what's called a non-recourse loan to leverage your 401k or your IRA
Right.
to buy real estate. And that's the example I gave. I might have skipped the most important statement, but that's on me.
Now, for clarity, in order to make that loan through your, leveraged by your IRA, you have to have the amount or more than the amount in your IRA, is that correct?
So as long as you have, so as long as your deal cash flows 125 DSCR, that's a service coverage ratio, and you can put 30% down, which is what you usually need for these type of loans. We go max leverage 70%, and so if you for example, you have $100,000, you can stretch it to like $300,000-400,000, right? Because if your deal is a good deal and cash flows, I can lend you up to 70%. You see, so. Essentially, as long as you have enough money in your retirement, and that's what we ask you questions like, what do you think the rents are going to be? If it's Airbnb, is it short-term rental or long-term rental, right? Short-term rental, you have the fluctuation of, days, seasons, right? Because the price will be different. So we take the rental data, plug it in, and then we see, okay, you have $150,000 in your account as cash.
Okay.
You're like, hey, if I want to invest $150,000 into a deal, tell me how much I can borrow, and then I'll run numbers and I'll tell you, okay, that $150,000, you can buy this amount of, you can get this loan as long as your property cash flow is X, let's say $2,000 for the sake of our example. Or you might need to put 40% down to get that DSCR 125, but I can only lend you, instead of 70% I can only lend you 70%, 60% of that, I apologize. You see what I'm saying? So essentially your retirement cash is what determines how much you can leverage. So that's actually a great question, because a lot of people think that for every dollar I have in cash, that's what I have to put into investment. Well, that's the opposite. We take your dollar you have in cash and try to leverage it as much as we can, as long as the deal can cash flow.
So the down payment may be, say, 30% of what you have in there or something like that.
Yeah.
And then you can leverage the rest of the loan.
Yeah, and the way we structure it. Yeah, and the way we structure is the
With a loan.
bar will be the 401k or the IRA. So you will be signing If you have a 401k, you'll be listed as a trustee, because that's kind of like the word owner for the 401k. If you have an IRA LLC, you'll be listed as a manager, which that gives you the signing authority to sign on behalf of your IRA. Now, if you have a custodian IRA, which is a little bit different, that's that third thing I talked about. Whatever custodian you have, which is, let's say it's directed trust company, equity trust company, they will actually sign on your behalf because they have that fiduciary responsibility. So, yes.
To do the non-recourse loan, does the solo 401k have to be with you guys?
So we only require the only part we require is the reserve requirement. So every loan has a reserve requirements, which is 6 months worth of PITI, so principal, interest, taxes, and insurance plus HOA. The reason why is we don't want you to, because of the IRS codes, how much you can contribute per year. If you fully leverage yourself and you have no more cash and something went wrong with your deal, you could be a millionaire on the personal side. You can't just pull money out of your account and drop it in if you ever did your max contribution, you see?
Mm-hmm.
So because of that reason, we always keep reserves, and that does have to be with Solera Bank, that's correct.
Okay.
Yeah.
How do you guys cash flow? Do you cash flow it on current year rents, or is it a 2-year average?
That's a great question. Depending on, I'm assuming long-term rental or short-term rental?
Let's go long term.
Yeah, so that's a great question. There's 2 ways to do it. Most of our buyers, or investors I should say, when they get a deal, they're either buying like an owner occupied or something like that, or like seller occupied in this particular example. So what we do is we do a market analysis. So we work pretty closely with your real estate agent just to find out what the market of comparables in that area. And then we verify your real estate agent and the information they provided us by doing what's called an appraisal rental survey. So when we order an appraisal, the appraisal will go in that area, and because the appraisal is from the area, he'll do what's called a rental survey, and he'll give us like a low and a high number, and we can take up to 110% of that, of whatever rents he projects.
Wow, so it doesn't even matter what it's performing, so once the appraisal comes back to that market analysis, you go by that NOI?
Yeah, but the only thing about that, the only part that is important to say is, as you notice, if I said solid occupied, now if you bought a property that is, certain states have laws like California, right? If you already have a lease in place, and if the owner changes, you can't kick the tenant out. You gotta honor that lease. So we would use that lease.
Okay, so it can't be month to month, it has to be.
Yeah, well, I'll give you month to month, I'll use the month to month.
So you don't care whether it's month to month or long term, whatever?
Yeah.
Just whatever that.
The only part that I do care about is if it's a short-term rental.
Okay.
And the reason why is because, which I've seen this happen quite a bit, you'd be surprised, they'll invest into, let's say, a condo, right?
Sure.
And what ends up happening, they invested as a short-term rental, but then the association said you can't have short-term rentals.
Yeah.
And then you're in like big trouble, right? I mean, I know it's crazy, but people have done it, I've seen it.
Or the city.
Or the city. A good example is Utah. One of my actually buddies who invests in short-term rentals through his solo 401k, he actually had 5 or 6 units. And what ended up happening is the city came in and said no more short-term rentals in this area, and he had to sell all his properties. So that's why you gotta be like pretty careful. Most people invest into short-term rentals in areas that are very touristy, Florida, Tennessee, mountains, California, things like that, just depending again where you're at. But only for short-term rentals is the one where we would use an analysis, like Airbnb, VRBO, and AirDNA and things like that.
Was there any special considerations once you cash out of the deal and then you end up with this extra capital and how you pay your loan back and what happens with the excess proceeds?
That's a great question. That's a great question. It depends how you put it in. If you did a Roth, then it's Roth, tax-free. We have to have that's tax-free, right? Because you were paid for it.
All the gains and everything?
All the gains and everything, yep.
Wow, that's
Now, if
big
it's
deal.
traditional, then you'll pay capital gains. There is one more thing that I did miss but I'll mention, it was on the slides, but if you have an IRA, there is a tax code called UDFI or UBIT, unrelated business income tax or unrelated debt finance tax. Essentially what it is, if you buy with your IRA, you might be subject to additional taxes, but you also get the credit benefit as well. So just a heads up on those
But you
IRA.
can only put so much into your Roth. You can't put 30,000 in when the cap is like 7,500 a year, right?
Well, you could put it as that's a contribution. So that wouldn't, if you're gonna put your max contribution, you choose that tax year by talking to your CPA and your professional, hey, I wanna pay for that money today and put it as Roth. But the limit is the limit itself. Yeah, it's how you wanna put your money in before taxes or after taxes. So there's also a part where you do like employee sponsor plan. Let's just say, I'll give you an example. I used to work for Wells Fargo. Before I left the Solera Bank, I had a 401k with Wells Fargo. I had the right to roll it over to either my employee sponsor plan with Solera Bank, or I chose to go the self-direct IRA route. And because my 401k had two components, it had a Roth and a traditional contribution, I opened up an IRA LLC with two components. So I have a Roth account where I invest all my Roth money, and then I have an IRA traditional where I invest all my IRA traditional, because you have to separate those. So.
And there's no problem using the IRA LLC method in which to do these investments?
There is no difference in investing within an IRA or sole way, but there might be different tax like obligations.
Sure.
So, but outside of that, it's a retirement account. There's also, I mean, there's other vehicles, obviously, like SEP IRAs. We didn't get into that. We're just trying to keep it very, very broad.
Right,
But.
they can only take so much.
Yeah, exactly.
But from all three, you guys have plenty of information.
Self-directed IRAs, I think there's a reporting requirement, right?
Yeah.
To the custodian, but is there anything going on with the 401k? Does it really just sit there and the money comes in and out for the investment?
I mean, I don't know every single report, so CPA obviously helps here, but for the IRA, there's a form called 5498, which is like your fair market value and stuff like that.
Okay.
And then there's also like a distribution contribution form. So if you did a contribution or distribution from your IRA, then you have to fill that out, because again, if you did a distribution, there's tax obligation that year. Whether it's Roth or traditional, doesn't matter. It's a penalty. You have to be 59.5 to pull out of your retirement account. If it's a solo 401k, mostly it's just filling out the form of how you contributed your money, whether it's Roth or traditional. So there's always forms involved, and we have like a whole kind of template and in-house provider that kind of help guide you that what needs to be filled out. But you do have to fill out forms for sure.
Okay. Do you have a card? Oh, you have
Yeah,
cards. Okay.
I have some cards. I mean, there's some other stuff that Ryan can talk about. But unless you guys have any other questions about solo 401ks or lending.
Is it different, how is it different from New Direction then? New Direction is custodian and you're not a custodian?
So New Direction is what's called a custodian without check or control. So if you went to New Direction and said, I want to invest into, let's say, real estate, they will make you fill out a form and they will distribute the funds for you. So there's a lot of fees, a lot of other things involved. So a lot of our investors but they do also give you benefit. They do maybe some of the forms for you, right? But really the fee structure is what different between IRA LLC and a custodian IRA.
How much different? What are you looking at as far as fees and what it?
That would be all depending on the structure, so I won't be able to really answer that right now on the spot. But like I said, we have a guy that's our in-house provider. He can be more than glad to set up a consultation and talk through all that stuff. Yes?
I just have a question logistically on how it works. So I have a self-directed IRA, but it does not have checkbook control.
Okay.
So if you have one that's checkbook control, I roll over $100,000 to you guys. You just put it in a checking account that I can then go ahead and write $50,000 for this syndication deal and $50,000 for this oil and gas deal, and
yeah.
And
so,
then what forms do I have to fill out that whatever form at the end of the year?
5498.
The 5498, and just say, this is the fair market value at this time.
Yeah.
And then I can sell that deal and then invest in something else and.
Yeah, but the key element to what you just said is important that when you sell the asset you own by your IRA LLC as checkbook control, that money comes back.
Right.
Because you want to have that record, because you are the plan administrator and the custodian of your own IRA LLC. So if you ever got audited, you want to have that money coming in and coming out. But yeah, money came in from, you sold the property, so you made $100,000. You put that back into your IRA LLC, now you see you bought additional 3 properties. You sold that and you came back. You see, it always comes back to the IRA's 100%. And so the 59.5, if it's traditional, you will obviously be taxed on what you withdraw. If it's a solo 401k, there's also tax complications there. So it's all about Roth or traditional, but you're 100% correct. The only difference probably with your IRA LLC is you probably don't have that freedom of doing alternative investment list that I just listed. I don't know if you saw that in the beginning of the slides. So you can't buy, let's say if you have a TD Ameritrade, or let's say you have Wells Fargo IRA, because they offer that. They won't be able to let you invest into cryptocurrency or buy gold or buy real estate. They just won't allow you. They'll tell you go find a different custodian. So,
Do you ever find that investing from your retirement accounts increases your chances for being audited? Have you seen that with your clients?
I've been doing this for 6 years with Solera Bank, and I have had 2 customers that got audited in my 6 years. And the way it usually works is they don't audit the 401k or the IRA, they audit the business that owns that. So for example, if you have a business and your business got selected, right, they will look at every single thing that you own. And if you own an IRA or a 401k, whether it's traditional or Roth, doesn't matter, they'll audit your whole financials. So that's when we saw a company got audited 7 years of their tax returns, and they went back 7 years on all their retirement returns, and we were working with the government to help with that. So yeah, for sure, happens. It's of course a risk. And
So that's not a trigger though.
yeah,
It's not a trigger, that's what I was curious
Yeah.
about. Or do you get moved to the top of the list like?
No, yeah, no, definitely not a trigger. Yeah, they like to call it like a red flag.
Yeah.
No, definitely not. No. If you do that with your business, maybe, but yeah. But
So then you said you have to set up an IRA LLC to help manage that? And then do you guys help with setting up that?
which part? The
That
part
LLC?
where if you want to open up an IRA LLC, is that what you're saying?
Yeah,
Yeah, we help set that up. We have in-house providers
okay.
who ask you a lot of questions and then direct you, which can advise you how to invest your money, but they can direct you, hey, this product might fit you better for what you want to do. So
Do you do backdoor IRA?
backdoor Roth,
Yeah.
Mega Roth,
Yeah,
we do help with that. That's a whole different thing, a whole different can of worm, but we can definitely help with that.
that sounds good.
Oh yeah, we're all about that.
Yeah, that sounds like a trigger.
Guys, all of you guys, Ryan, do you have anything you want to add at all, or anything
Yeah,
you want to
Bobby.
add on real quick?
The only other thing I'd say is, Abram, he stole the spotlight. I knew he would, and I was like, hey, can I get 30 seconds? Can I get 2 slides?
I was shy, but I questions.
Just that, so Abram, he does a great job on the retirement lending. Solera also offers like traditional lending products for investors as well. So that's kind of the area that I work on, is the multifamily or the investment type of products. So if you're looking for traditional lending outside of your retirement, we offer those products too.
Yeah, and they do a great job. I've worked with each and every single one of these individuals and different things, and highly recommend each and every one of them and what they do. So they are extremely valuable experts to reach out and get knowledge from. I want to thank each and every one of you guys for coming and hanging out with us tonight. Snippet of some slides from Abram, and you can grab my card on your way out. I'm happy to share that information. Obviously happy to share Tanner's information, so that between all these different avenues, you can make your money make money for you, steal from your 401k and how to make extra money, and talk with all the other possible multifamily pieces that are out there and see how you can leverage his life insurance, your money here, and other money here. Does anybody have any questions at all for Wise, for Adam, Tanner, Abram, Ryan, anything at all?
I was gonna say, along those notes too, if you're overwhelmed by tonight and you haven't had enough wine, I can relate. But I'm happy to, you can take one of my cards as well. I'm happy to set up, I have a Calendly. If you just shoot me an email, I'll send you my Calendly link, and we'll do a 20-minute Zoom if you have questions like, that show up like, at 3 o'clock in the morning when you wake up and you're like, whoa, I didn't ask that. Same thing I think with Kari and Scott, and of course our speakers, like,
Absolutely. Yep.
it's a lot.
and I wanted to kick off the new year again with areas that support your strategies to look at what you want to do next. And I wanted to bring in some individuals that I thought I know that are experts in this area, and it just helps to create some areas. I'm happy to bring one of them back without all 3 of them and do that kind of stuff as well. But it creates some areas for discussions, and we're not going to stop growing our group or doing those things out here. And next month, since she's here, I'm going to introduce her as well. So next month in February, we're going to talk about parts of the questions and your 1031. So when you sell that property and you don't want to pay those capital gains, and Aaron Crawley back here is going to come in represent asset preservations. and talk about your 1031 and ways that you can strategize doing that. And then you can actually come back and talk to these guys again in that area. So that'll be next month. And I'm trying to think if there's anything else.
And then March, we've got
Cassandra.
Cassandra's coming
AI.
to teach us how to use AI.
Yep. That'll be a good one.
Yeah.
Mhm.
And then April is happy hour, so.
Homestead's done paying for
But just so you guys know, also, we meet every month on the second Tuesday of the month. So most of our speaker meetings will probably be here, happy hours, you know.
I'm bringing
let you know.
fans next
So it's
time, I
the second
apologize.
Tuesday now going forward?
Correct, yep,
Okay.
second Tuesday of the month, every month.